Welcome along to the deep dive.
Great to be here.
So today we're going to dig into that Q3 2025 earnings call for, well, this newly combined company.
Yeah, the big one. And the market reaction was pretty loud, wasn't it?
It really was. Shares jumped, about 7% after hours?
Roughly, yeah. And, that kind of move tells you the market's buying the story, or at least starting to.
So this deep dive, it feels like it's more than just the numbers for one quarter.
Absolutely. This was the first real kind of check-in, the first big test to see if management is actually pulling off this huge consolidation.
This whole vertically integrated homeownership platform idea.
Exactly. Leveraging scale, leveraging AI.
Yeah.
It's ambitious, no doubt about it.
Okay, let's unpack it then. Let's start with those headline results. What specifically got the market so excited right off the bat?
It really came down to efficiency, I think, and that operating leverage starting to show. The big number was adjusted EPS, came in at 0 to 7.
Right, and consensus was quite a bit lower?
Yeah, estimates were more like 4, maybe 5 cents, so a significant beat there.
And adjusted revenue?
Also strong. $1.78 billion, that was actually above the high end of their own guidance range.
Okay, but let's do the nuance check. Because the GAAP revenue number, that actually missed estimates. Just slightly, $1.61 billion.
True. It did.
So why did the street basically ignore that? Why focus purely on the adjusted figures?
Well, I think it boils down to the adjusted EBITDA, $349 million.
That translates to the margin, right?
Exactly, a 20% adjusted margin. And you have to remember, last quarter that was 13%.
Wow, okay, 7 percentage points up in one quarter.
In this rate environment.
Yeah.
That tells investors that the changes they're making, they're actually working. They're controlling costs. They're getting paid for the volume they're doing.
So the market's betting on the trend, the direction, not getting bogged down in the GAAP details for now.
That's how I read it. They see the operational improvement.
And underneath all that, the actual mortgage business, the core stuff, how did that hold up, especially with all the integration chaos potentially?
Performed really well, actually. Net rate lock volume, $35.8 billion. That's up 20% year over year.
Okay, 20%.
And closed loans, $32.4 billion, up 14% year over year.
So even with the market being tough, they're gaining share.
Definitely gaining share.
Yeah.
And what's maybe even more impressive and feeds back into that margin story we were just talking about.
Yeah.
The gain on sale margin, it stayed right at 280 basis points.
Held steady.
Holding that margin, which is, crucial for profitability while you're integrating Mr. Cooper and Redfin. That shows they didn't have to just slash prices to get that volume.
Right, they maintain pricing discipline.
Seems like it.
Okay, so this leads us nicely into the bigger picture, the strategic transformation. Management's big push is to get out of being seen as just another cyclical mortgage originator.
Yeah, they want to be a category of one. That's the phrase they used.
Combining the originator, Rocket, with the huge servicer they bought, Mr. Cooper.
The largest servicer, yeah. And then Redfin, bringing in those high-intent buyer leads.
So the core idea is resilience through the rate cycle.
That's the whole thesis. Build a business that's kind of naturally hedged. Rates go up. Okay, the value of your servicing portfolio, your MSRs, that increases. Gives you stable income.
And if rates fall,
then the origination side, which is massive now, just captures that refi wave, captures the purchase demand. It's designed to smooth things out.
And they backed this up with some pro forma numbers, didn't they? Showing historical stability.
They did. They put out financials suggesting that if this combined company had existed earlier, it would have posted positive GAAP earnings every single quarter from early 2023 right through this last quarter, Q3 2025.
Okay, that is probably the single most important data point from the whole call, isn't it?
I'd argue yes. For a mortgage company to credibly claim they can eliminate those wild earnings swings, that's huge. It suggests they might have actually cracked the code on managing that interest rate risk by balancing these different business lines.
So the theory is sound. Let's talk execution, because integrating acquisitions is notoriously difficult. How are they doing on that front? Let's start with Redfin. That closed about 4 months back.
The momentum there looks pretty good, actually. That mortgage attach rate, getting Redfin buyers to use Rocket Mortgage, it's climbed from, I think, 27% at acquisition to nearly 40% now.
40% already. Their target was 50, right? That suddenly looks, well, quite possible.
Very possible. And it's not just volume, it's quality purchase volume. Redfin's already feeding 13% of Rocket Mortgage's retail purchase loans.
13% in, what, 4 months? That's significant contribution.
It is. And on top of that, they've already found $140 million in annual cost savings from Redfin synergies that they expect to hit the books next quarter, Q4.
Okay, fast progress on Redfin. What about Mr. Cooper? That deal only closed October 1st, just weeks before this call. They were claiming immediate seamless integration.
Yeah, the numbers they threw out were, frankly, kind of staggering. By day 9, they said 40,000 leads had already flowed from the Mr. Cooper servicing portfolio into the Rocket sales pipeline.
40,000 leads in 9 days.
That's what they said. And get this, by day 12, they'd already closed the first loan for one of those clients. Took just 3 days start to finish.
Okay, that is incredibly fast. Almost too fast.
Well, management sounded very confident they're on track for the full $400 million in cost synergies they promised from the Cooper deal.
40,000 leads, though. How much of that is just, the easy stuff? People who are going to refi anyway?
Yeah.
Can they keep that pace up? That's the question.
That's the key question. Absolutely. Yeah. Investors need to watch that. Management's confidence seems based on 2 things. One, they've kept saying they have line of sight to that $400 million synergy number. And 2, just the sheer scale of what they call the recapture engine. This combined servicing book is almost 10 million clients. That's the biggest pool of potential repeat customers in the industry.
And Rocket's own recapture rate was already pretty good, right?
3 times the industry average, they claim. So the opportunity is taking that successful process and applying it across the much, much bigger Cooper portfolio. That's the core bet here.
Right, scaling their existing strength. Okay, so this whole structure, the scale, the speed, defending the margins, it all seems to rely heavily on technology, on AI.
Definitely. Management was very clear. AI isn't just about cutting costs. It's essential for defending that 280 basis point gain on sale margin, and crucially, for handling more volume without just hiring thousands more people.
They talked about specific AI tools, didn't they? Not just vague promises.
Yes, and this is where it gets really interesting, I think. They detailed specific AI agents they launched in Q3 and, importantly, gave actual results, quantifiable impact.
Okay, give us the examples. What are these things actually doing?
So on the revenue generation side, there's the pipeline manager agent. What it does is rank incoming leads for loan officers and even drafts suggested text messages customized in real time.
And the impact.
During that little rate dip in September, they said this agent led to a 9-point increase in how often loan officers followed up with clients. And more importantly, a 10% lift in refinance conversions.
Okay, a direct link from AI to more closed loans, that's tangible.
Very tangible. Then on the efficiency side, cost savings, capacity.
Yeah, where are the big gains there?
Back office stuff. There's a purchase agreement AI agent. It apparently cuts the time needed to process a purchase agreement by 80%.
80%, that sounds huge.
Adds up to over 150,000 team member hours saved annually, they estimate. And for their mortgage broker partners, there's the Rocket Pro Underwriting AI agent.
What does that do?
It takes the broker underwriting time down from about 4 hours typically to under 15 minutes.
4 hours down to under 15 minutes for underwriting.
Yeah, that's a massive change in speed and certainty for their partners.
So if you tie all this AI stuff together, what's the overall productivity impact?
The big stat they highlighted was that their production team members, the loan officers, processors, underwriters, can now handle 63% more loans each than they could just 2 years ago. 63%
more capacity per person.
That's a huge competitive advantage. It means they can grow volume in the future without their costs growing nearly as fast. They can scale using tech, not just people.
Okay, so the engine seems to be running really well internally. How did management translate this into guidance and context for investors looking ahead?
Well, they were still pretty cautious on the overall housing market, acknowledged it's thawing, as they put it, but, existing home sales are still historically very low.
But they did get some help from rates in Q3.
Yeah, that 30-year fixed dipping about 40 basis points down to 6.3% in the quarter definitely provided some needed relief.
Okay, so looking forward to Q4, the first full quarter with everyone combined. What's the guidance?
Adjusted revenue guidance is between $2.1 billion and $2.3 billion.
And what's interesting within that range?
What stood out to me was the core business strength. If you kind of back out the new contributions from Mr. Cooper and Redfin, the original Rocket business, standalone, is still projected to grow about 7% year over year at the midpoint.
7% organic growth, even with seasonality and high rates. That's still strong market share gain.
Exactly. It shows the core engine is still firing, even before you fully layer on the acquisition benefits.
And they gave a little peek towards 2026 as well.
They did. Cautiously optimistic, I'd say. They pointed to external forecasts, like Fannie Mae projecting maybe 25% market growth next year.
25%? Wow.
Yeah, in hopes that mortgage rates might actually dip below 6%.
So you combine their internal efficiency, the new scale, and potentially a market tailwind.
That operating leverage could really kick in during 2026. Oh, and they also made sure to mention liquidity. Pro forma, with Mr. Cooper included, they have about $11 billion total liquidity. Plenty of cushion.
Right, financial stability is there. Okay, perfect segue. As we always do on the deep dive, it's time for our This Is Not Financial Advice segment.
My favorite part.
So put on your hedge fund analyst hat. You're pitching a high conviction, maybe slightly aggressive trade idea to your investment committee based on everything we've just discussed. What's the pitch?
Okay, committee. Look, the stock popped 7%. I get it. People say it's still tied to housing. Maybe the synergies take time. But my pitch is, this is a structural long. So we need to think about a fundamental re-rating here.
A re-rating? How so?
The market is still, I believe, massively discounting the value of that combined entity. Specifically, the sticky annuity-like nature of that enormous $613 billion servicing book, now combined with the Redfin-led engine that's clearly working faster than expected.
So you're saying the multiple is wrong?
Yes. The market needs to stop thinking cyclical originator multiple and start thinking scalable tech platform multiple. That's the core thesis.
Okay, provocative. So how do you structure the trade to play that aggressively but maybe hedge against integration screw-ups?
It's a combo trade. First, we sell some downside volatility. We sell some medium-term out-of-the-money puts. Let's monetize the market's lingering doubts. Collect that premium.
Okay, selling puts.
Then we use that premium, maybe add a bit more capital, and we buy long-dated calls, slightly out of the money. We're betting that this stock continues to re-rate upwards over the next, say, 4 quarters as they prove out that full $500 million in total synergies.
So selling puts, buying longer dated calls, betting on continued upward momentum and synergy realization. What's the pushback? What's the biggest risk the committee throws at you?
The risk is simple: execution. Integration fails or just drags on longer than expected. Synergies don't materialize as quickly. That's the obvious one.
And the outrageous part of your pitch, the component that makes it aggressive.
The outrageous part is the speed claim. It's the conviction that these AI-driven efficiency gains we talked about, they fundamentally changed the cost structure, permanently lowered it. So even if the housing market stays kind of through 2025, the margins hold up like they did in Q3.
You're betting the AI makes them resilient now.
Exactly. And it means when the market does eventually turn, maybe in 2026, they can scale output dramatically without scaling costs nearly as much as competitors. They're built for faster, cheaper growth thanks to the tech. That's the aggressive bet.
Got it. A high conviction play on structural change and AI leverage. Okay, let's recap this deep dive for everyone listening.
Sounds good.
The key takeaways seem to be, number one, really exceptional execution so far on integrating both Mr. Cooper and Redfin, much faster than many expected.
Yeah, the early signs are very positive there.
Number two, demonstrated AI capabilities that aren't just theoretical. They're translating into real measurable lifts and conversions and significant efficiency gains, protecting those margins.
The proof points were strong this quarter.
And number three, a Q4 outlook that, even when you strip out the acquisitions, shows continued organic growth and market share gains in what's still a pretty tough environment.
Right. Underlying strength is still there.
So let's leave you with a final thought to mull over.
Here it is. If that Mr. Cooper recapture engine, that ability to pull customers from their massive 10 million client servicing book back into new loans, if that really hits its full potential next year, how quickly does the market narrative shift? How fast does this company get re-rated away from being seen as just a cyclical mortgage lender towards being viewed as a stable, tech-enabled platform with recurring revenue potential? And maybe more importantly, what kind of valuation multiple does that kind of durable business model deserve?
Something to definitely keep an eye on. Thanks for joining us for this deep dive.
Always a pleasure. We'll see you next time.